Hi, this is Bobby Jones with On Call Capital. One of the subjects that often comes up when discussing an apartment offering with a client is what is IRR? The IRR, or internal rate of return, is one of the most regularly used indicators in evaluating potential investment performance in an apartment syndication. Typically expressed in a percentage range, say 12 to 15%, the IRR is the annualized rate of earnings on an investment. When evaluating a potential investment, you can use the following ranges to tie the asset class to IRR. Number one is your core holdings. 8 to 12% IRR is what you expect for those. Basically, you're buying a great property without a ton of value add or even appreciation components tied to it. Number two is your value add. That's roughly 12 to 18% IRR range. And you're expecting to come in with that property, make some pretty standard improvements, but it's already a pretty solid property. Number three is more of an opportunistic investment. That's 18% or more IRR. So you're probably doing some kind of a huge facelift or a heavy conversion with a property that needs some love. So you can follow the general rule of thumb that the higher the IRR, the higher the return. And the lower the IRR, the lower the risk, right? Wrong. You have fallen for one of the classic blunders. As powerful of an indicator as IRR is, it should never stand alone when you're evaluating an investment. If you want to properly assess a deal, you must consider other factors, such as the math behind the IRR and how IRR and net profits vary based on when cash flow is distributed. Let's look a little closer at what IRR means so you can properly use it in your evaluations. IRR is closely tied to the net present value, or NPV, of a property, which is the difference between an investment's market value and its total cost. If the market value of a property is greater than the total cost of buying, renovating, operating, and selling the property, then this property has a positive estimated NPV. Remember that IRR is the annualized rate of earnings on an investment. To be more accurate, though, there are two other ways to put it. IRR is equal to the interest rate that makes NPV equal to zero, or IRR is also equal to the interest rate that makes the market value and total cost equal. The actual equation is quite complex, so we're not going to delve further into that here, but suffice it to say that there are different variables that can be manipulated by sponsors to produce a more favorable IRR. The two simplest variables are cash flow and distribution timing. Simply put, IRR takes time value into account. So let's say you invest $100. The investment has a cash flow of $10 in year one and $40 in year two. At the end of year two, the investment is sold and the $100 is returned. The total profit is $50 because you had $10 in year one and $40 in year two. Simple division would say that your return was 50%. You got 50% on your money, but the time value of money affects returns. And so the IRR for that particular investment is only 23.43%. If you had received the $50 in cash flow and the $100 investment back all in year one, then your IRR would be 50%. But spreading out the returns over those 2 years, and in that way, where more returns were on the back end, negatively impacts the IRR. In short, the more cash flow you get early on in an investment cycle, the higher your IRR is for that particular investment. IRR should never be looked at in a vacuum, though. In fact, I would suggest that you pair it with the equity multiple, which is the subject of another video here on the site. So make sure you check it out, along with all of our other informational videos. If you enjoyed this video, I hope you'll stick around by clicking subscribe. Also, feel free to visit my website at www.oncallinvestments.com for more information about apartment investing. I'll see you next time.